Hey, this is Justin with DayTradeTheMarkets.com, and in this video I want to discuss several ways in which you can use the DayTradeTheMarkets software for getting into trades, for trade entry ideas in other words. And in the video I'm going to show some very specific concepts and some examples, but before I do I wanted to very briefly discuss the idea of trade entry on a more theoretical or more philosophical level. If you really break it down, as a trader, you are a professional decision maker. Make consistently good decisions and you're going to get paid handsomely. If you make consistently bad decisions, you're going to be looking for a new line of work pretty quickly. And if you break down good decision making a little bit more into detail, it's essentially the ability to weigh various decisions in real time. You need to be able to weigh the level of opportunity that exists in the market at a given time versus the level of risk that would be required to take advantage of that opportunity. And of course, you're never going to be right 100% of the time, but if you can consistently enter trades when the opportunity in the market outweighs the risk, and you can consistently avoid trades where the odds are not in your favor, you're going to come out on top. So that leads to what we call the three rules, if you will, for increasing your edge. And rule one is to avoid as many low expectancy trades as possible. In other words, first and foremost, keep yourself out of trouble. And I spoke about that concept in great detail in the prior video, and I highly recommend that you watch that video if you haven't seen it yet, because it's just such a powerful concept. And really, it was the concept that turned around my trading career when I really grasped the concept. Basically, what you want to do is learn to put the market into context first before you even consider taking a trade. You know, you can use the software to determine which side, buyers or sellers, in other words, is in control of the market at a given moment, and then you can eliminate the other side as a possibility, and by doing so you can avoid as many of those no chance, dead from the start trade type ideas. Now rule two is getting into more high expectancy trades, or getting into more good trades, and that's going to be the real focus of this video and what I'm going to dive into next. And by the way, what we call rule three is maximizing gain on winning trades and minimizing your loss on losing trades, and I'm going to speak about that in detail in the next video on exit strategy. So, but for now, let's focus on how you can use this software, the DayTradeTheMarkets software, to get into more good trades, rule two, if you will. And really, the possibilities are endless, but for the sake of this video, I want to discuss the two most common ways that we recommend using this tool. And the first is as a decision aid that you can use in conjunction with what you're already using. The second way is by using some specific trade setups that we teach. So in terms of the first method that I mentioned, that's using this software as a decision aid. So what do I mean by a decision aid? Well, let's say that you are currently using a method, or you currently have trade setups that you like to use, or whatever the case. It could be literally anything that you've developed, anything you've learned, just a trade setup that you're currently using. Very simply, let's say that your method gives you a signal to get long. Now, rather than just blindly taking the trade and hoping for the best, what you would do instead is you would refer to the DayTradeTheMarkets software, and you'd look at the real-time aggression data on the software, and you would determine if the context of the market agrees with taking that long trade. So in other words, is there evidence that buyers are in control, or other pieces of evidence? And if so, that evidence, that confirmation, is going to give you that extra degree of confidence or edge to pull the trigger. And on the other hand, let's say that your method, the trade entries that you're using, gives you a signal for a long trade, but in this case, the context of the market is not confirming that it's a good idea. It's telling you that instead, perhaps bears are coming into the market, or it's saying beware because you're buying right into a resistance zone, or could be anything. The filter could be red, whatever the case may be. But in this case, you simply skip that trade that you were given. It's a less than ideal setup. The odds are not as strongly in your favor as they were if the evidence was lining up. And hopefully you can understand that idea and see the power in that concept. And really, I really love it when people use the software this way. We've just seen it time and time again, how effective this can be, and how people can go from losing money or breaking even to making money, or how people can go from having moderate success to having a great deal of success simply by using the software like this. So I guess I would say, if you've ever felt like you're really close to breaking through with your current method, or you're just a little inconsistent, then we've seen it time and again, and I can say with a very high degree of confidence that you would greatly benefit from using your trading setups in conjunction with the Day Trade the Market software as a decision aid to again give you that extra bit of confirmation, or perhaps conversely to give you a bit of a red flag warning sign to avoid a trade. So the second way, so beyond using it in conjunction with what you're already using as a decision aid, the second most common way that we use this, or that we recommend using this, is by using the software directly for trade entry. And of course, like always, your first job or your first order of business is to use the software to put the market into context. In other words, you want to understand the story the market's telling you on a given day. But once you're in step with the market and you can clearly determine that you want to be in the market in a certain direction, then another way to get on board, get into the market, is to use the Day Trade the Markets software directly. And we've actually come up with, or use and teach numerous trade setups, and we arrange them by what we call trade type. We have Confluence trade setups, what we call the wrong point trade setups, go with trade setups, reversals, fades, and so forth. And what I thought I'd do is just go over some basic examples. This is what we call a Confluence setup, and this is our first basic concept that we think makes a lot of sense. And if you've seen other videos that we do, there's 6 or 7 different pieces of evidence that the software is giving you and that we analyze. And the idea here is that if you can have the patience and the discipline to wait for situations when 3 or 4 or 5 or 6 of those pieces of evidence line up or come together at a given time, or form what we call confluence, then you're going to have a situation that's a very high edge type trade. Again, it doesn't mean it's going to work 100% of the time, but if you do have those situations where things line up nicely, it's a very, very high edge or high percentage type of a trade. And that's really what it's all about, is putting the probabilities and putting the odds, putting the edge in your favor. So just for example, in this example, and this is generic, there's a lot of different ways to do this, but in this case, our bigger picture bias heading into the day was up, so all things equal, we'd rather be on the long side. You can see our filter's green, which is bullish. You can see that we've had some bullish structure, some level 2 bars, high velocity moves, level 2 bars, the level 3 bar, or the level 2 selling bar get no follow through. Here's a level 3 extreme buying bar. So it's all signs are kind of pointing that you want to be on the long side. So you've got pieces of evidence lining up there. Now we also know that the low of a level 3 bar should act as support. We have this green real-time support zone. We've got these decelerations as well if you're looking for extra confirmation. But what you can see here is that in this area right in here, you've got a lot of confluence. You've got a lot of things lining up. Again, bigger picture bias is up, support zone, deceleration, filters green, structure of bulls being in control. A lot of things are lining up, so it's a very high percentage place to be getting into the market. There's confluence in that zone, in that area. Hopefully that makes sense. And again, there's a lot of different ways you can do this, but you're basically thinking about, okay, what are the pros? What are the evidence, and what's the evidence in favor of doing something versus the evidence against? And when one outweighs the other, then it becomes pretty clear. That's the idea of confluence. That's kind of the first idea, or the first concept that we teach, and I think it's certainly a very powerful concept. Requires a little bit of patience, but it's again a very powerful concept or idea. Another trade setup, this is something I like as well, is what we call the wrong point trade setup. And in other words, what this means, and I've just got a pretty generic example here, a couple of them actually, but you have a reason that you want to get into a market, and we talk about different structures that you can use. So the first thing you do is you define where you would be wrong, okay? So for example, let's say you were looking to get, we had this level 2 buying bar on the high. The resistance from earlier has changed over to support. We know that's a pretty good area to be looking to get long, near that support zone, assuming other evidence is in place. So, what would be a wrong point? Well, a wrong point would be, 2 or 3 ticks below the low of this support zone. So in this case, it would be at, let's say, 76.25 in this case, okay? So that's where you would say, okay, if the market hits there, I'm wrong. So at that point, then you think about, okay, how much money risk, how much dollar risk, how many ticks of risk are you willing to take? If you're willing to take 1 point of risk, then you'd put a limit order at 77.25. You're going to take 4 ticks or 1 point of risk, and this would vary by whatever market you're trading, how many contracts. If you're willing to take 1.5 or 2 points, then you would put your entry up in here. Okay, so again, when this zone formed, which was right at this time. Okay, so the trade-off there is if you wait for more of a retracement, you have very little dollar risk between here and here. Okay, versus a little bit more dollar risk between here and here, or a little bit more dollar risk from here and here. The trade-off is this thing may take off without you. So it's a trade-off, but the idea is you've defined where you're wrong, and you've defined how much monetary risk you're willing to take, and then you simply enter the order when those things are aligned. So it's kind of like reverse engineering the trade idea. Same concept here. As it's developing, you've got we know the low of a high velocity move should act as some pretty good support. We've got a green support zone. So again, let's just say, for example, you would want to put your stop, your wrong point, so to speak. Your wrong point would be 2 ticks below the low of this support zone, which in this case would be 1679. Okay, so if you're willing to take 1 point of risk, then you put a limit order right in there. If you're willing to take 2 points of risk, you'd put your limit order in there. And again, there's more risk if you take a trade up here than if you take a trade, with half the risk. But again, that's something you determine ahead of time, how much dollar risk you're willing to take, and you accept the trade-off that, if you only will take a trade from down here, the thing may take off without you. If you're willing to wait and have patience, then you're going to take less dollar risk. So again, determine your wrong point first and then reverse engineer your entry. So hopefully that makes sense. It's also a very powerful concept. It's one that I use a lot in my personal trading as well. It's the wrong point idea. Another series of trades we talk about are go-with trade setups. We have several that we teach. There's a pure breakout trade, what we call the level 3 retracement, level 3 continuation, sweet spot trade. I like that one a lot. High velocity trade and so forth. Thought I'd just give a quick example of some go-with trades. And these are types of trades that you would use with the trend, or momentum-based trades, go-with type trades. So, for example, here is a situation where you have a level 3 or an extreme buying aggression bar on the high of the day. When that forms, you've got a few options really, and again, it's that trade-off between opportunity and risk. If you feel like the opportunity is great, then you'd probably want to take a little bit more risk, versus if you want to be a little more cautious, then you could take a little less dollar risk, but the trade-off is that it could take off without you. So when this level 3 bar forms, you've got a couple of options. One is to wait for a retracement, what we call the level 3 retracement trade, right down to a tick above the low of that level 3 bar. Another option is to simply just take a pure breakout, just buy right at the market as soon as that bar forms on the high of the day. Okay, obviously that's a little bit more risky, but you're not going to miss out. And another option is what we call the continuation trade, where you can see if we get some full bars above the high of the level 3 bar before we even test the low, then you can, instead of buying at the low on the retracement, you buy at the high on the continuation. Okay, so 3 options right there, just 3 different various trade setups, which again we would call the level 3 retracement, wait for it to test the lows, lower risk, the breakout, which is a little bit higher risk, or get a little confirmation that it's heading higher, and then buy on what we call the continuation back to the high. Okay, so those are 3 different options. Same thing here. When this bar forms, you have an option. You can just buy the breakout. You could wait for a retracement down to the low. You could wait for the continuation toward the high. And you can see in this case we actually get, this is an interesting example, and why I chose this, we actually get 2 in a row. So you've got a situation here where there are 2 level 3 buying bars in a row, and this is what we call the sweet spot. You can see where they overlap. That's a really nice place to be looking to get long as well. Okay, it's kind of the continuation trade on the first level 3 bar and the retracement trade on the second level 3 bar, but it's a bit of a situation where they come together, and that's a good spot. It's what we call the sweet spot. So again, we have several other go with type trade setups, but the idea again is you've identified that in this case bulls are in control, you want to be on the long side, and then you look at the software and determine an entry point based on that. And again, it's just a little bit of a trade-off between how aggressive you tend to be versus how risk averse you tend to be, and you can wait for more of the pullbacks or retracements versus more of just the momentum based go with trades. But either way, you've got really solid market based data driven evidence that things are happening, bulls are in control, and this is good location to be getting into the market. So in other words, you've identified you want to be long, you've identified the market is in a vertical type of a phase or a momentum type of a phase. Now you've got some choices as to how to get in the market. So again, hopefully that makes sense. Those go with trades are pretty powerful type trades. Another idea here are reversal trades, and we've got a few different trades: level 3 reversal, overlap, we call the overlap trade, which I like, the extreme opposite aggression trade, aggressive scalp, and so forth. Just as a real quick example, here's an extreme opposite aggression trade, okay? And what you can see here is we've got some pretty strong buying and some level 1 buying, and you can see we test up to the high, and right at the high of the day, this is pretty rare, but right at the high of the day we get some extreme aggression in the opposite direction. So some level 3 or extreme selling aggression comes in off the high of the day. That's a pretty good sign of a reversal. Now, does it always just go make new lows for the day? No, but it's a very good sign of a reversal. And again, same idea. You can either just, wait for a retracement toward the high of that. You can wait for a retracement back on the continuation, or you can just kind of buy it's not really a breakout, but just get on board knowing that this is a pretty strong reversal type of a setup, okay? So again, reversal trade, but you're using actual order flow driven evidence to show you that real sellers have come in off the high. You're not just trying to be a hero and sell the highs and hope you're right. You've got some evidence to back that up. So that's one example of a reversal type of a trade setup. Another thing that we like to look at are what we call fade type setups, and these are rejection type setups, or setups that you would use in consolidation situations. But again, you talk about putting the market in context and identifying when a market's in consolidation, when a market is in a mode that it would make sense to wait for a rejection or wait for some extra confirmation. Here's a couple of examples of some fade ideas. You can see here we've got this level 3 or extreme selling aggression bar. In this case, you could wait for obviously the retracement. You could just get on board, or you could wait for a retest back into this bar, kind of what we call fade the extreme, and see if you get a deceleration, and then jump on at that point. That's one way to do it. Another thing you can do is you can see where the market's in a bit of a consolidation and look to fade, look to buy lows of consolidation, sell highs of consolidation. Here's more of a breakout and then retracement fade, where we've broken out, we've turned from support to resistance, and a lot of times you just stick a limit order in there, but you could also wait for some extra confirmation and fade that zone in that situation. So again, just giving some real quick examples, but the key point being you're making sense of the market, making sense of the context of the market, and then using these tools directly to give you some evidence to enter the market in certain places. Again, so you can use these in conjunction with things you've already done, or you can use this in the trades that we teach directly. So again, conclusion, that just what I said, you want to make sense of the story that the market is telling you at a given moment, and from there you simply figure out a way to get on board. And whether you use this again as a decision aid with something you're already using, or you trade directly off of the trades that we teach, or perhaps you simply use this tool to come up with a unique approach that's all your own, the key is with better information and better tools come better trading decisions, and from those better trading decisions come better results. So hopefully this has made some sense, and you can begin to visualize for yourself how you might be able to use this to increase your edge and to make better trade entry decisions. So by all means, let us know any questions that you might have. We would certainly love to speak with you about this in more detail, or answer any questions that you might have. And beyond that, I highly recommend that you watch the next video, which deals with using this software to make better trade exit decisions or trade management decisions. So with that said, we'll end the video now. Take care, and we'll speak to you soon. Thanks.